Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. It's 25 past 11 AM on Sunday the 28th of March 2021 and we're going to spend the next few minutes looking at TLT, 20-year Treasury ETF. Right, now what we're going to do as we always do on the channel, we're going to start with our basic technical analysis first and that Elliott wave analysis second. But before we do that, let's give you a quick rundown of the chart in case you're new to the channel. So we have our Elliott wave count, which is all the numbers and letters. Let's just move that out of the way. We have 4 exponential moving averages, 10 in yellow, 20 in blue, 60 in orange, 250 in green. We have a volume profile here on the right hand side showing the various peaks and troughs of the buy sell volume, with the extreme of which being marked by this yellow dashed line, which we refer to as the point of control. We have a MACD with a 10 for the short term moving average, 20 for the long and a 9 to smooth. We have an RSI set to a 10 close with the 30 green level representing oversold conditions and the red 70 level representing overbought conditions. Right then, let's zoom in and have a look at what we can see on the weekly time frame here. So below the 10, below the 20, below the 60 and below the 250 exponential moving averages on the weekly time frame here, looking dire really in terms of just how nasty this move down has been. We've fallen through all of these traditional forms of basic technical support and have continued to push lower and lower. However, signs of a bounce in the last week. We are still below the 250, 10, 20 and 60 exponential moving averages here, which is traditionally a death cross. And as you can see, as it's played out, it's just pushed the price down further and further. The MACD here shows that bearish momentum might finally be dying off, with the shorter term average starting to level off and starting to flatten out here. No sign of a crossover yet, but we do have a slightly lighter red bar on the histogram here suggesting that bearish momentum is dying off. We have an RSI here telling us that we've reached extremely oversold conditions around 15, I'll make it 15.24, which is about the most oversold I've ever seen the 20-year Treasury, to be honest, in the time that I've been observing it, which is a few years. But we have reversed and seem to be heading higher. So there's a bounce on the cards, I think. How long term it is, we had one here and it was only lasted a week. This one may last a little longer, we can't be certain, but there is some evidence to suggest that it might, and I will show you that now on the daily time frame. So from a basic technical analysis, we have a low and a higher low in the MACD trending higher over the last few weeks, last couple of weeks. We have a low on the RSI and a higher low in the RSI heading back into neutral territory between 40 and 60, and a low and lower low in price. So low and higher low in RSI, low and lower and higher low in the MACD, but low and lower low in price. This is called a bullish divergence, and it's pretty significant divergence to go from extremely oversold back to just oversold back into neutral territory. So strong divergence here, bullish divergence. At least in the short term, this could be a completed move down. Right, so let's bring up our Elliott wave count and remind ourselves what we're expecting to see. So we know about this bullish divergence, so I want you to keep that in mind and in the MACD while we discuss the count here, which we consider to be the final part of a 3-wave move. We're looking at an A, B, C move like that. So we know we're in the final part of it. We're just trying to figure out where it's going to finish. So the count which says we're done shows us the final 5 waves down like this. Okay, and there's a 1, 2, 3, 4, 5 into the 5th here. This would complete the 5th minute wave of the C minor wave of the 2 intermediate wave, and then we're off going higher, and this was the bottom and we're done. Okay, so that's one count. The alternative count has us in a wave 4 heading sideways for a little while before we head lower. Okay, which is this count here, like so. This brings us to parity at 131.09 between the A and the C on our arithmetic scale. Right, so that would bring us a little lower. Now, being honest, I brought on this bounce because the bullish divergence is good enough for me on the short term. I don't know I'm right, okay, in calling this to bottom. Like I said, I've got an account which brings us lower, but this is good enough for me in the short term. We've had a very clear, if you've been observing it over the last couple of weeks, we've had this trend higher in the MACD, growing bullish bars on the histogram here. We've had this bullish divergence on the RSI over the last couple of weeks as well, and then we've had this bounce. So let me just try and add a little bit more evidence to why I think it's a not definite, but a probable, strong probability that we've bottomed here. But let's not read too much into it. So we're going to shift into log scale now, and I'm going to drag down from the length of the A and project from the B. What's interesting here is we find, I'm just going to bring that down just to the top. Let's make sure I'm accurate. And we're just going to come over here and make sure this starting point is accurate as well. Yep. And also make sure that we've got the bottom right where it should be as well. Right there. Okay, so what we find is that the one-to-one relationship of the A projected from the B comes directly to where we've bottomed. If we just zoom in here. So as you can see, the white line, this is a one-to-one parity. We've wicked through it ever so slightly, unless I've just managed to move the whole thing. Just be careful, make sure we haven't made a mistake. So that's on the bottom of that one. No, that's fine. Yeah, so we have gone one-to-one parity down here in log scale, literally to the tick. Came straight down one-to-one. So we've done it in log scale. We've gone A to C parity. We've got bullish divergence between these two lows, low and higher low, trending MACD to support it, low and lower low here to confirm that bullish divergence, one-to-one parity, and we've bounced. Another thing I would like to point out, which also gives support that we may have bottomed here, is the overall retracement of our proposed wave 1. So if we just come up to the top here, we can see that where we bounced, we know that this low here at 133.21 was the one-to-one parity, but look at where it stops. It stops right between this yellow line and this orange line. This is the 61.8% retracement, and this is the 65. We call this the yellow zone. Or well, some traders call it the golden zone, whatever you like to call it. It's the area where we like to see most in a retracement before we buy. And that's what we've seen, and it's a place where you're likely to find a wave 2, either at the 50 or the 61.8, 65 region. That's exactly where we've come to. So like I said, short term, at least, that's good enough for me to call that a bottom. So let's look about the kind of risk you'd have to take now as a trader if you're in already. Then we know, don't we? If you've already brought the cutoff, the invalidation point is the previous low at 133.21. If you're not in yet, what do you have to risk if you were to get in now? Well, ideally you always want to see this initial move back up to resistance and then an initial pullback. Well, we're in that pullback now, but is it over yet? Are we going to get 3 waves lower, or are we done and we're now already heading higher? So from where we are, knowing that the invalidation point for a long position would be at the 133.21 or just beyond it to be absolutely certain. Let's just have a quick look what we're dealing with. So 2.2%, that's down to you. That's down to you as a trader. Is that too much risk, 2.2%, or are you fine with that margin? If you're fine with that margin, there's a long setup here to be had with an obvious stop. Okay, now let's look at the invalidation point to the upside. Now this is assuming that the wave 3 is complete here with a 4, and we, where is the invalidation point? How deep could that 4 come up? Assuming that we haven't bottomed. Well, the invalidation point's all the way back up here in this green box, this white line, which is the bottom of the minute wave 1, which is 149.98. Now, I personally do not want to wait, and will not wait that long to get into a long trade to see the bearish trade invalidated, because it's such a long wave 3. What are you talking? You've got to sit back and lose 8% from that was from the high, sorry. So from where we are, you've got to sit back and watch 10% disappear. So there's just no way, you know, it's just no way you're going to let that happen, are you? So I think always, never, ever, ever is this financial or trading advice, but a 2.2% risk from here if you were to get in. That's up to you. If you're already in like me, then the 133.21 is your cutoff. Your invalidation point for the bearish count is all the way back up here at 149.98. So let's just have a look at that from a trade setup for a moment. So we already know. No, we don't want to measure. We don't just want to measure, do we? We want. I could have swore I had that long position. Here we go. So. Alright then, so 2.3%, I don't think that's quite on the line, is it? There's a 2.2% risk to the downside, even if the bearish count were to prove correct and were to turn around at this invalidation point or just before it, there's still 10% to be made. Just up to there. Now obviously the wave 4 could turn around at any point. If we are bearish, it could turn around at any point, and that's a potential threat to the downside, which is your cutoff here at 2.24. As the trade moves up higher, you can always move your stop to adjust as the wave structure becomes clearer. If we do see a 1, 2, 3, 4 coming up and you start to get this wave structure more clearly, you can always move your invalidation point to the bottom of the wave 2, which will secure your profit and make sure you're safe, because you could be looking at 5 waves into an A, 5 waves into a, into a C. We don't know exactly where it could end. So that's all I've really got to say for the meantime, guys, on TLT. It's been an absolute slugfest. They've been getting, 20-year Treasury has just been getting absolutely beaten about the head for months now. But there may be signs of life here. Now, it could be short term. It could be short term. We could be just in this wave 4. We could go into a triangle. We could go into a flat. We could go into a zigzag before we push lower. Or we could just break down from here and this entire trade could be invalidated tomorrow. We don't know, do we? So that's the best setup I think there is at the moment, given the fundamental support, given the basic analysis support of bullish divergence, trending MACD, increase in bullish momentum, finding a pivot here at 1-to-1 parity in log scale, and between the 61.8 and 65 retracement levels of the wave 1. All of that's good enough for me in the short term to be long here, and that trade setup's comfortable with a 2.2% loss. If you're not in yet, that's for you to consider. And that's it. I'm going to leave it there, guys. So if you're new to the channel and you like what you've seen, please subscribe, smash the like button, leave us a comment in the comment section below if you want to. Feel free to share any of these videos and hit the bell notification icon to remain informed of future releases. Alright guys, take care, and I should be back with you with another video soon. All the best. Bye bye.